Commoditisation has made it easier to know the price of everything, but the value of nothing, or so a cynic might say. I'm David Elwood, Pricing Director for the Energy Transition at General Index. And on this podcast in 2024, we're exploring the markets coming to prominence in the age of the energy transition. Commoditisation in these sectors, that's the likes of hydrogen, carbon, sustainable aviation fuel, is often elusive. Pricing and standards far less well-defined, and value derived by their capacity to help combat climate change. For the carbon-intensive energy sources being transitioned away from, commoditisation is far more advanced. But pricing and standards rarely stand still for long, and the era of energy transition will challenge existing norms like never before. Oil markets have long been at the vanguard of pricing evolutions. You can check out our series on the Brent crude benchmark for much more on that. And from time to time, we'll delve into these markets to learn how they may evolve over the transition and ask if they can offer any lessons to those vying to replace them. It's with this in mind, we turn our attention to today's subject. Producing and transporting nearly a quarter of the world's crude oil, no discussion of fossil fuel or environmental policy is complete without a deep dive into understanding the workings of the Middle East crude market. To help guide us through this terrain, I'm joined today by Russell Robertson, Chief Commercial Officer at the Dubai Mercantile Exchange. Russell, welcome to the pod.
Good morning, David.
Also on the line from Singapore, my co-host for the day is Aabha Gandhi, who as Pricing Director at GX, covers the Middle East crude market on a daily basis. Aabha, also welcome to the pod.
Morning, David.
So, Russell, perhaps we could kick off. Could you introduce yourself and tell us a little bit about the DME?
Sure. My name's Russell Robertson. I'm the Chief Commercial Officer for the Dubai Mercantile Exchange. I've been with the DME for 5 years now, and previously to that, I was with some other big exchanges globally and have a background in trading of derivatives too for many years. The DME, or Dubai Mercantile Exchange, is a energy exchange based in Dubai with international outreach. We focus very much on oil pricing in the derivatives landscape, and we are partnered with the Oman Investment Authority. And our contract is the DME Oman Futures contract, which creates a price for 5.5 million barrels of oil per day.
Okay, we'll come back to in just a moment to explore a bit more about the role that the DME plays. Perhaps, first though, I'm really interested, laying at the epicenter of global energy markets, how would you describe to an outsider to the industry the Middle East crude market?
Sure. As you mentioned, 25–30% of the world's oil production comes from the Middle East. So there's a number of key participants in the Middle East who are producers and exporters of crude. The biggest one you hear about is generally Saudi Arabia, but Iraq, Iran, Oman, who is a partner of ours, Kuwait, Bahrain, they're all exporters of crude oil. A large number of that crude from the Middle East goes to this area which we call the East of Suez. The East of Suez is basically Asia. China is a very big component of that and takes a lot of that crude, but also Japan, Korea, Vietnam, Thailand, Malaysia are all beneficiaries of Middle East crude. Historically, Middle East crude has not really gone to Europe, but that's something that has started to change a little bit as geopolitics change and Russian oil goes to different areas. But Middle East is a very key, important part of crude exports, particularly for Asia. And we expect to see that continue to grow as we move forward.
Albert, any other thoughts on Middle East crude markets? You cover these day to day. How would you characterize them? They're quite a dynamic part of the energy space.
Right. Yes, they are. And I think Russell's done a good job in terms of dividing how the crude goes. Agreed. We do see crude flowing into Europe as well. Of course, some of those flows have seen a bit of change because of the ongoing Red Sea situation. But pretty much, yes, that's how crude is covered. A lot of the Middle East crude does come into the Asian markets. India, I think, is also another important buyer of the Middle East crude as well.
I know we're going to come back in a little while to talk about some of the the more kind of current market fundamentals. But first, Russell, you touched on aspects of the DME's role and its partnership with Oman. Could you expand a little bit more on the role of the DME in this market?
Yeah, sure. It's sometimes good to give a bit of history. So back in 06, 07, the DME was a collaboration between the Oman government and what was then called NYMEX, which is now the CME Group. NYMEX was the trading floors of energy trading floors in the US. And back in those days, when you bought oil from the Middle East, you were buying oil that you did not know the price of. So you bought oil, it got delivered onto your boat in 2 months' time. And once it was shipped, you then found out what you were going to pay the government for that oil. So that made it quite difficult for people to what we now know as hedge or manage your risk. So what DME was actually the first one to do was to work on a way that would allow the price discovery of Omani oil at a point now for future delivery. So what you can do is we're actually on the last day of May today. So you're actually trading for July loading. So I can buy oil today on the exchange at a price that is determined for July delivery on a boat. So that is quite a key change. So it's gone from what we used to be known as retroactive pricing to now futures pricing. So DME was the first company to do that. There are others now that follow that same pricing methodology. So the DME initially was just an Omani price. So and Oman was particularly important because historically it's been referenced as a benchmark for Middle East oil, mostly to do with its politics. It's quite a stable country. It's also outside the Straits of Hormuz on the Horn there, so it doesn't get impacted by a lot of the geopolitics that happened within the Straits of Hormuz and the countries that are around the area. So that was a good benchmark for stability and pricing. And since 2007, we've also seen Bahrain, Kuwait, Dubai, Saudi Arabia, all using our price to price it, either all of its oil or as part of its methodology for pricing. So it's a key relevant indicator about what's going on for Middle East crude within the region and globally.
You mentioned earlier some of the volumes. Could you touch on those again? How is this? What's the quantities? What's the scale of the growth in this of the exchange?
Yeah, so the exchange volumes, we look at it in two ways. We have the trading volume. So last month, for example, we traded 84,000 contracts in our front month contract. So that's a month that you trade for pricing. That's the equivalent of 84 million barrels of crude. That's a long-term high. This year we're also, and that's as a year-on-year number, that's up 63% since 2020. So we've had significant growth over the last few years. We also are physically delivered futures contracts. So for the audience that might not know, a lot of people who trade derivatives trade on a cash basis. So at the end of the month, when the contract expires, they're just a cash movement. On contracts like DME Oman, it's a physically delivered contract. So if I'm long at the end of the month, I'm expected to take delivery of oil onto a boat. Now, DME Oman's contract is actually dubbed the world's largest physically delivered crude oil contract. And that's due to the percentage number of oil barrels that come out of the exchange versus that are traded. So this year, we're again at a long-term high, averaging around 26 million barrels of physically related oil coming through the exchange each month.
And it's interesting that distinction between those who are kind of speculatively involved in the contract and those who want to deliver or receive physical oil. You mentioned 84,000 contracts last month. Roughly how many of those, I don't know if you can put a percentage or an actual contract number, how many of those actually go to delivery?
It's around about 25%, roughly 25 to 30%. If you look at some of the other,
reasonably high. Seems
it is very high, yeah. If you look at other oil benchmarks, Brent, for example, isn't physically delivered. That's a cash settled contract, so you can't compare the two. But something like WTI, which is obviously a huge benchmark, trades 20+ million contracts a month. the number that go to delivery is something like 0.01%. So in comparative terms, they're very different instruments to trade.
So would you, the contract then is would you say that it's far more reflective of the physical market in the region than perhaps some of like these other contracts are often kind of bellwethers of so many other things, but is this a much better indication of regional physical crude dynamics?
Yeah, for sure. I mean, it clearly is, because the percentage number of people who are trading the contract have exposure to the physical side of the oil too. That doesn't say that the other contracts are incorrect. They are correct. They're just used in slightly different ways. Brent and WTI, or maybe Chinese I&E contracts, are all very relevant contracts. And for Middle East, we are just, over the last maybe 2 years, our volumes are growing and becoming much more relevant to traders. So traders historically are very happy to trade very liquid instruments like Brent and WTI. However, now they're becoming a lot more sophisticated with their pricing models, and therefore looking at other contracts like Oman, Dubai, Murban, things like this, which are historically more niche, but much more relevant when it comes to hedging your portfolio in a more precise fashion.
Russell, out of curiosity, since we've seen this growth in contracts that are trading and actual physical deliveries also happening, the majority of the crude presumably is moving into Asia, and a lot of it is going into China. Or are we seeing, I mean, are you seeing other destinations come up as well in the physical delivery of the crude?
Yeah, so the exchange looks at it in two different ways. The ultimate end user, so when you see the report from the Ministry of Energy and Minerals or the Port Authority, the end barrel is quite high. It's like 80% or maybe more ends up in China. From our perspective and the trading on the exchange, the Chinese trading community is around about 50%, so it's much less. And people, what they do, they trade back to back. So you might receive oil from the Ministry of Energy and Minerals. However, you might trade that barrel back to back to the OTC market. And that's the thing that we see changing over time, is that back to back has got less. So the physical barrel itself is not necessarily changing hands so much. However, the trading of it and the hedging of it on paper terms has increased. And that then we see end users becoming more broad, and the destination of the barrel doesn't change, but the community of people trading it has got much wider. I think for Oman last year, it was something like 8 different destinations. So it wasn't just China. There was even some barrels went into the Netherlands last year. So it's definitely changing.
Right.
And in terms of evolution of the contract, Russell, what sort of plans are afoot to innovate or to see an evolution there?
So the current contract we have is quite a well-known benchmark now. The community likes it as it is. What we do see and what we're working on a lot is the people who participate in that product. There's still room for growth from the end users who may be typically using the big benchmarks for hedging, and educating them on how to better hedge their book. I'm not saying I'm better than them, but it's just another way of looking at things. That's one area. We're also going to be listing a new platform this year, which we call ACE. It's a very cool name, but it actually stands for Alternative Crude Ecosystem. And what we're trying to do is we're trying to create more liquidity closer to the end of the month, when physical contracts become less liquid. And the ACE platform will allow people to trade what's ultimately a spread between different oil grades, using the futures contract as an underlining, but basically do a cargo swap between different Middle East grades. So you'll be able to put a price on the screen for a differential between Dimi Oman and Basra, Dubai, Murban, Upper Zakum, things like this, which we hope, as volatility increases as you get near the end of the month, it'll allow people to maybe switch barrels and create more liquidity into the market, which is ultimately what we're always trying to do as an exchange: fair pricing with more liquidity and more participants.
And I know that there's I don't know whether this is something you're able to talk about, but there's like this sort of the ownership structure of DME is quite broad, right? There's a whole range of investors from across the industry, and you've got a new or expanding investor coming into the mix. Could you tell us a little bit about that?
Of course, yeah, it's very exciting. So we have recently announced that the Saudi Tadawul Group, which is the exchange operation of the Kingdom of Saudi Arabia and part of the PIF group, will be taking a third ownership within DME. That's alongside a third ownership with CME Group and also the Oman Investment Authority. So it's 32.6% ownership of each party, and that will allow us to move into other areas within the derivative industry, not just energy, but minerals and metals and commodities as a whole. The idea being that the Saudi Arabia want to build a commodities market within the region, and using DME expertise to ultimately find transparent pricing for those commodities within the region. So GCC commodities as a whole, how do we create pricing benchmarks using derivative contracts, and to allow local community to be able to have exposure to those markets. So we hope we will change our name as part of that, and we're going to change from the Dubai Mercantile Exchange to the Gulf Mercantile Exchange to give us a broader outlook, and we hope to unveil that new name and our branding at the end, maybe the beginning of Q4 this year.
So as part of that, do you think that will allow for like sort of diversification away from, I mean, perhaps not necessarily away from crude, but kind of complementing it? I'm curious, like, what do you think are some of those challenges for the DME, or what will be the Gulf, the GME, and other exchanges kind of reacting to the energy transition and this kind of the evolving state of play really for traditional markets such as crude?
Well, crude markets are still growing. I mean, a lot of people are talking about energy transition, but I mean, in Q1 this year, numbers were up about 1 million barrels a day. Q4 last year, over 104 million barrels per day of oil was still being produced and consumed. Growth is still expected for the next few years in oil, so oil is not going anywhere. And you can have personal views about that. I'm just talking about it from a purely economic terms. How that transition take place is really difficult to see at the moment. From what I see and the clients I work with, there doesn't seem to be a clear pathway yet of a collective group of people moving towards a united product or products, which makes it difficult for derivatives exchanges, because ultimately we are secondary markets. We're not there for spot trading or long-term contracts of like LNG from Qatar. They price out for 10 years and no one trading that stuff. So for us, it's waiting to try and work out where we see the opportunity of a collective group of people moving towards particular products, and then we can start to think about developing those into secondary markets. But at the moment, there does not seem to be a clear pathway to what that could be. Things like green ammonia and hydrogen seem to be causing some interest and excitement. But if you look at the side notes to that, ammonia is a toxic product. Is that a good thing? How do you ship it from one place to another? How do you crack it when you get there? These are quite big questions and involve quite a lot of investment to move forward to these areas. Carbon capture is another thing I found very interesting, but the investment into that is huge. But we are seeing that happen. That's very different to carbon credits. So the spread between the pricing of these different carbon credits is equally a huge challenge in itself. So I think we still need to see the market. And again, I appreciate I'm talking about it in a cold sense and not the other side. But I mean, just from what I see, how the market's developing, it's not really moving as quickly as maybe the political agenda is doing so, which makes it hard from a business perspective to create something to support that.
Exchanges have been very nimble to adapt and seize opportunities over the last 10, 15 years. In my research for this, I could see that you've had the good fortune to work at some of the world's leading exchanges. I'm curious to get your take on how you've seen the workings of those exchanges evolve, and how you think that they are like placed to help with some of these transition tasks and challenges going forward.
So if you look at the big exchanges, so I spent time at ICE and CME, which are the world's biggest exchanges. They are very nimble and they can move very quickly. The thing that's changing over time is it's much harder to lift the product, a new futures contract in a new area, or something that's slightly different to something people are used to. Traders are very difficult people to persuade to do something different. If they're very used to trading a particular product and they're comfortable to do so, it's very hard to persuade them that something else is better. So what exchanges are having to do much more of now is to put in a lot more time and effort and research into finding areas that are truly innovative and ways of resolving issues in the market that they face today. That has to be quite significant. I mean, if you look in some of the commodity markets, particularly the soft market, you can see that at the moment, cocoa and orange juice. If you look at the price action that's happened there just in this last week or two, or aluminium, for example, all these things are quite big subjects that derivative markets are core center part of, and trying to find ways to fix or to help alleviate some of those issues is very difficult to do. And ultimately that really is where we need to all move now, because just listing a copycat of another Brent contract or something like that just in another region doesn't generally work like it used to. The different exchanges are gradually finding identities, I think, rather than just being these huge cross asset conglomerates. They're becoming much more focused in different areas. Yeah, and that's not a bad thing. It just gives their community hopefully more things that they need to trade and to make their book more efficient, because a derivative contract is a tradable instrument, a speculative item, but its ultimate beginning is to be able to hedge a price exposure in a physical market. That's the core competence to me. I mean, we can actually just add, I guess, bring it back to oil. I mean, something else that's transpiring as we go at the moment is how futures prices are impacting the spot market, so the front physical market. So Oman has obviously been around for a while, and people know that the price of Oman crude is going to be based on the price from DME or from Dubai. We're very linked to those things. However, there's new products coming to the market, such as Murban, and how things such as the change of ADNOC and Abu Dhabi, how they're changing the refining capacity. They're refining more Upper Zakum and releasing more Murban, which allows people to trade more. And that has an impact on other price benchmarks, such as Dubai. And now that flow of trading is now making a full circle and coming back and impacting how the physical market participants are actually going to trade. And what gets a bit geeky, but what's a bit interesting about that is ultimately you end up being the end user, like a refinery in China will start thinking about, oh, what's the price on the exchange next week versus what's the price that I'm going to hear from a broker, or how do my counterparty see the value of this asset? They're going to be looking at the exchanges as a way to develop their what we call refining economics, and that has an impact even again on what products are pushed out to the market, because the consumer might want X, but ultimately the refiner is going to want to produce what's more profitable. So it's a huge evolution, if you like, of the impact of futures pricing onto the physical market, and it's quite interesting as you get in. It's quite a rabbit hole, but it's very interesting to see how that futurization is changing commodities.
Well, I think that's a good juncture at which to let Aabha head off on the rabbit warren of market fundamentals. So Aabha, over to you.
Thanks, David. So I'm going to take this opportunity to just segue to Murban, since we've had a discussion around it, and straight ask you, we've seen a flood of the Murban convergences in Dubai, last month. And, what did you hear from Singapore and Far East, and, how did you see so much of that grade being delivered?
From my perspective, we obviously saw more flow. and therefore an increased participation of trading of those barrels because there was additional barrels to trade. The market is now in a position where they can make use of that as a trade flow, and traders need something to be able to build a portfolio. The idea that you can just walk into the derivative market and start trading a book is quite difficult. So once you get a bit of flow, you can start building from that. My personal perspective is I think it's a great thing for all derivative markets because it creates more spreading opportunity, arbitrage opportunity. If people are willing to trade that product, then they'll trade DME against it or Dubai against it. And then all of a sudden, I call it the east to west spread, but now you have Brent, WTI, INE, DME, Dubai, all these different products. They all have very different relevance is in something we've not talked about here, but the quality of that oil, what it means and where it goes, the molecule compounds and all this sort of stuff, that chemistry of it, is why all these different things have a different price. And the last 2 years is probably the first time in the history of oil that you've been able to actually have access to trading those differentials. And at the same time, we're at a point in history where there's more freely traded barrels of oil in the market than ever before. So when we talk about freely traded, what we mean is some countries, when they sell oil, it's on what we call destination only. So if I buy a barrel of oil from Saudi, that goes to my refinery. I can't sell it anywhere else. Whereas if I buy a barrel of oil from Oman, I'm allowed to trade that barrel to a secondary person. So the concept of freely traded is now at all-time record highs due to ultimately the destination restriction being removed from derivative markets. And hence why you see this additional volume in the market and having an impact on all of these pricing mechanisms that we see today.
Correct. Interesting. And I think we're also at a very interesting crossroads. We're just 2 days away from the OPEC meeting as well now. We've seen these trade flows change, evolve. And you're right. I mean, a lot of it has happened over the past year or so. Partially probably, got to do with the fact that now we see Middle East refineries also starting up and in full swing, whether it's Al Zour, Ruwais, Duqm also starting up. So certainly there's been that, whole trade flow shift as well. But coming back to this whole trade and having so much like this, different kinds of grades being available, what now remains the key focus is the OPEC meeting as well in 2 days' time, really. What are your reflections, and what do you see as the challenges for the producers this time around? For the meeting and us heading into the physical summer months now.
So OPEC is in a difficult position because the market still has a lot of risk in it at the moment. When we talk about risk, a risk is priced into the market. So if something is worth $5 today, and then something looks like it's going to cause a problem to that particular product, supply and demand. Everything in trading is always to do with supply and demand. I bore people with this, but you can get very complex with everything. But everything you trade is always comes back to supply and demand. Whether there's more or less of this stuff, you're going to ultimately create the value. So whether you talk about OPEC or you talk about geopolitics or you talk about shipping, all these things, it ultimately depends on how much of the asset there is going to be in a location at that time. The less of it, the higher the price. The lower, the more of it, the less of the price. It's that simple. OPEC's a good example of this. So what OPEC does is they decide on how much production the members of that community is going to create or produce and export. And they've been holding back production at this time. To your question, what do I think going to happen? I have no idea from an exchange perspective. But the market does seem to think that they're not going to change anything at this point. There has been some people talking about maybe it would be a good time to start releasing some additional barrels, just because forward thinking says that the longer they hold on, the harder it will be to reintroduce more production into the market. The price of oil is trading at $85 roughly at the moment. We've been in an $80, $90 range for quite some time now. If you look on a chart, 82, $83 is a key area. So what they do with that crude, if they produce more, yes, the price will come down a bit, but it could go down more, and vice versa. So there's a lot of play at the moment. We still have a lot of geopolitical risk in the Middle East. There's a number of things that could still happen. So I think with all of the unrest at the moment, it will probably look like they're not going to do anything, and there will be a bit more of a wait and see, I think.
Approach, yeah. Russell, just to draw back to one thing, you said last year Oman saw 84,000 contracts. The Oman contracts, 84,000 Oman contracts were done last year?
Last month.
Last month, sorry.
Yeah.
Year on year, you said the growth was about 60%, right? What is it now? Like, how much are you expecting for the second half of the year? Do you see this 84,000 contracts to increase over the next 6 months of the year?
Yeah, so 84,000 contracts is just 1 month's trading volume of our front month contract.
Right.
So 84,000 last month was the high we've seen since roughly 2018 on a monthly basis.
Okay.
When we look at post-pandemic, when liquidity fell from then to 2023 year on year, it was up around 63% in just front month trading. Physical volume is roughly the same. I think in 2020 it was averaging around 11 million contracts a month. This year we're averaging around 26 million contracts a month of physical volume. But front month has jumped again this year, and it will be higher again this month. So as of this morning, and we still have 1 day to go, it's getting close to 89,000 contracts this month. So again, we're looking at numbers which are way before pre-pandemic, going back into 2018, 2017 now almost. So for us, that's a great thing. It's a lot to do with new participants entering the market, refineries and people like that who historically would just trade Brent are now getting involved into the paper market. We spend a lot of time speaking to these end users, how to better manage their portfolio of risk from a pricing perspective. But also we're seeing more people come into the market from a speculative opportunity due to the east to west oil portfolio that I mentioned earlier. So the ability to be able to trade all of these different things on a screen is something that's relatively new and quite exciting opportunity for people to have the ability to access that market.
All right, great. Thanks, Russell. That was just very interesting, and I was just very curious to see what the trend was really looking like as well in terms of contracts being traded. And to ask an additional question, then what are you seeing as some of the key themes for the second half of this year, as we also see the contract volumes increase in terms of trade, right? So what is your expectation? What are the key trends that you are seeing for the second half of this year?
From a fundamental point of view?
From the fundamentals point of view, yes.
Okay, so geopolitics is a key issue, and there's a number of different areas to look at there that involve the oil market. So Russia particularly, and what's happening with Russian oil, where's that oil going to go, who's buying it? India is a key buyer of that crude. So how that continues to play out is going to be a key factor on the Middle East, and where the oil from the Middle East would normally go to India, where will that go? Of course, where there's other geopolitical issues in the Middle East, and that is not impacting energy flow at the moment, but an increase in that could have more impacts. However, I think also, again, I feel cold talking in this way, but I'm just talking purely from a business perspective. This is not my personal opinion. So from a business perspective, more importantly to financial markets is what's going to happen in the elections. So the UK partly, but much more importantly in the US. So I think the second half of this year, people are going to be looking very, very closely at interest rates, inflation, and what we call macroeconomics are going to be a much bigger driver to what happens to not just oil markets, but financial markets in general. So you've got the UK coming soon, US in November. Whether you like these people or don't like them, there is going to be an impact, and how those impacts, how those people impact relationships with other countries. That is, to me, the key thing. How will US east to west business look like post this year will be very interesting.
Right. Yes, indeed, there are some very interesting macro themes that are floating. I do agree with you. Interest rate is one very key thing, certainly as well. David, over to you. I think I've asked my bit on all things crude. Over to you.
Thanks, Aabha. Oh, look, Russell, look, thanks very much. It's been a really fascinating conversation. I know it's somewhat of a left field choice to throw Mideast crude into an energy transition series, but I think it's really key and important to remind people how this is a transition. It isn't a overnight change, and that many of the actors in this space are thinking about some of those new markets. You mentioned green ammonia and green hydrogen and others, and that the exchanges who have experience in the legacy markets will bring that experience to help the transition as well. So thanks very much. Just to conclude, the question we ask all of our guests: 3 words. Can you give us 3 words to sum up your market?
3 words. Black, I guess, oil, right? Middle East gold. There you go. How about that?
Middle East gold. Okay, right, yeah, that's a good one.
Yeah.
Okay, well, great. Thanks very much, Russell. Just to say, everyone, you've been listening to The Price of Everything, a podcast from General Index, the world's first technology-led benchmark provider. And this podcast is only possible because of the quality of our guests. So if you'd like to appear and discuss pricing in your market, get in touch through our website. Our producer is Andrew Wheeler, supported by Jano Media. My co-host today has been Aabha Gandhi, and I'm David Elwood. Goodbye.